Looking ahead into 2016, we see divergences emerging as a strong theme across economic growth, monetary policies, deal valuations, and corporate performance. Let me explain. Firstly, there is clear divergence in growth across major economies. Let's compare US and Europe. After a strong recovery, US economy experienced a modest slowdown in the second half of 2015, and the IMF revised its growth target down for US in 2016. In contrast, though, growth in Europe picked up strongly, and the ECB's commitment to quantitative easing is expected to give the economy a boost in next year. Meanwhile, in Asia, China missed its first growth target in 2 decades. However, India emerged as the fastest growing major economy of 2015. Monetary policies among the major central banks are also diverging. In the US, the market is widely expected to have already priced in increases to the Federal Reserve interest rate. At the same time, the ECB is committed to keeping the interest rates low. And this presents opportunities for global companies to take advantage of the credit conditions in Europe to raise additional debt that can be used to fund M&A. Third, there is divergence in corporate performance. Since the financial crisis, European corporate earnings have trailed that of US. However, the gap is expected to shrink, particularly if European demand picks up following the ECB stimulus. We are already seeing European corporate margins increase at a strong pace since 2013, while the S&P 500 companies have seen 4 consecutive quarters of declining earnings. The P multiples for deals in the US and Asia are well above their 15-year average, whereas in Europe, they're still close to their long-term average. The European companies have access to local markets that are expected to grow faster than many other developed economies, making them attractive acquisition targets at favorable deal PE multiples. All this means there are genuine opportunities amidst divergence, and how the corporate sector reacts to such opportunities will define deal making in 2016.